Hello there. Welcome to Economics N4. We've got a question that we want to look at here from June 2023. This is a question on multiple choice question. The first part of the question, which is question one, and here we are seeing question one is under section A. And the question reads, so we are going to start with 1.1, and it reads, various options are given as possible answers to the following questions. Choose the answer and write only the letter A to D next to the question number. That is from 1.1.1 to 1.1.10 in the answer book. Right. If you look at the first part, that is 1.1.1, it reads the most important indicator that is constantly measured to assess the wealth of an economy. That is the one that we are looking for. Then we've got options that we are given from A to D. A, we've got GNI. B, we've got GNP. C, GDE. And D, we've got GDP. So these are abbreviations. If you expand them, if you see a GNI, it represents a gross national income. And also, if you look at a GNP, it's gross national product. So these two mean the same thing. They mean that these are the total monetary value of the goods that are being produced by the local residents, no matter their location. We have residents, the people with a nationality of our local country, for example, South Africa, South Africans, who are producing outside the country. So those include them, and those who are producing locally, we add together to get the total, and that total will represent gross national income or gross national product. So if you look at C and D, C and D also they have a common explanation, because when you look at GDE is a gross domestic expenditure, and GDP is a gross domestic product. So gross domestic expenditure only includes exports, and GDP includes both exports and imports. So that's the only difference that is there. And we would see that they all mean the total monetary value also of goods that has been produced domestically. So if you look at the most appropriate according to our question is saying the most important indicator that is constantly measured to assess the wealth of an economy, you would see that GDP is the one which is more inclusive in terms of its calculation. So GDP, which is gross domestic product, becomes the most appropriate. So on number 1.1.1, you would see that we have GDP as our appropriate response there. Then we'll move on to the next question. The next question reads, restoration of the economy to a former or a better position. So we would want to see according to the responses that we have, and we would see that all these responses are explaining the phases that we have in a business cycle. So let's start with A. A is peak, and we know that a peak is the highest point when the highest point that an economy can operate is a peak. When the economy is operating at its highest point, that is we've got the highest level of economic activity that is in the economy. That's when we are operating at a peak. Then the recovery, that's when the economy is starting to improve, or we have got an upward shift in terms of the level of production of goods and services in the economy, or generally the economic activity is now increasing. That's when we have a recovery. So you see that this is the most appropriate according to the explanation that we have of restoration of the economy to a former or a better position. Then you would see that a trough is the lowest point that economy can operate on. When the economy is operating at its lowest point, it represents a trough. And then a recession, that's when the economy is starting to decline. There's a decrease in terms of the level of economic activity that is in the economy. So we are left with the most appropriate answer that we have there is recovery. So two, we have recovery as our answer. Then we move on to 1.1.3. Let's move on to 1.1.3. If you are on 1.1.3, saying an objective fact or announcement is a dash statement. So you see that a position, and a position statement is the one that is more objective, and it's more of a fact. So you see that position is most appropriate answer that we have there. Let's look at normative. A normative is a subjective statement, so it doesn't fit the explanation that we have there in the question. And you look at the Keynesians. The Keynesians relate the demand of products to the level of employment. It explains that if you have got a low demand of products, we are going to have a high unemployment level in the economy. So it's out, and then the monetaries explains about the connection that is there, or the relation that is there between the supply of money and the demand of goods and services. That is, if money supply increases, obviously the demand will also increase. So we are left with A. So here we've got A as our answer. That is now on 1.1.3. So if you move to the next one now, we let's indicate here we've got A as our most appropriate there. Then you go to 1.1.4, and 1.1.4 reads the concept of opportunity cost is what? And then we know that opportunity cost is the cost of the best alternative for goal. When we are talking about opportunity cost, for example, we have got a choice that we have to make between maybe A and B, and then we choose A. Opportunity cost becomes the value of the best alternative that we have forgone, that we have not chosen. So the value of B becomes the opportunity cost. So let's see, according to the responses that we are given there, part A is saying can be applied to the analysis of any decision-making process, which is true. And then if you look at B, is relevant only in economics, which is not true. Opportunity cost can be applied in every situation that we are given. We cannot confine it only to say it applies in economics only. So we go to C, refers only to actual payments and incomes. So the fact that we have got only, it makes that response not correct and applies to consumers but not firms. Again, it's confining itself to consumers, not firms. So the most appropriate that we have there is A, that is, it can be applied to the analysis of any decision making process. Then we go to the next one. If you move to the next one, we are now on 1.1.5. Then on 1.1.5, it reads, returns to scale refer to changes in output when all input factors are increased in the same proportion in the long run. And it may be, and we understand that in the long run, these inputs can be, they can be constant. That is true. So the most appropriate that we have there is constant. So on 1.1.5, we are having B as our most appropriate response that we have there. Then we move on to the next page to see the next question. We are now on 1.1.6. So if we move on to 1.1.6, we want to see what response we have there. Right. When we come to 1.1.6, it reads the convex shape of an indifference curve can be expressed in terms of the law of, and then we have A up to D according to the responses that we have. A is diminishing marginal utility, B is demand, diminishing marginal rate of substitution, D is substitution. So you see that the convex shape of the indifference curve can be expressed in terms of the law of, you know that the shape of the indifference curve is, or the slope of the indifference curve is called the marginal rate of substitution, or the gradient of the indifference curve is measured as the marginal rate of substitution. So and that marginal rate of substitution, it declines as we go down the curve. So we are, the most appropriate that we have there is diminishing. Diminishing means it's reducing. It's a reduction in terms of the marginal rate of substitution. So C becomes the most appropriate. Then you go to 1.1.7, is the most important determinant of how much a household will consume is. So we are saying the level of consumption of a household is mainly determined by what? We look at the responses, all the responses that we have can lead to that. But which one is the most appropriate according to the responses that we have? We look at interest rates. Interest rates on its own means the cost of borrowing. So it means when this cost of borrowing is reduced, you see that it's now easier or cheaper for the public to go and borrow more money, and then they acquire more money, and then obviously their potential to consume will increase. But it's coming in the form of an indirect way. But if you look at income, income becomes one of the primary determinants of how much a household will consume, because if income increases, obviously, it is going to have a more direct impact in terms of determining how much a household will consume. So we have B as the most appropriate. Also, of course, we've got tastes and preferences. So tastes and preferences, obviously, they come as secondary factors because the taste and preference are then strengthened now by the level of income of the household. Then availability of the products also become as a secondary determinant. So the most primary one is income. So you've got B7, you've got B as the most appropriate there. Then we move on to the next one. You are now on 1.1.8. 1.1.8 reads an issue that is related to the labor market. We know the labor market, that's where we have got the buying and selling of labor, that's where we have got demand and supply of labor, and obviously where we have an intersection of that demand curve of labor and supply curve of labor. That's when we have got determinants of the wage, right? So if you look at the responses that we have, you'll see that we have the rent, which is not part of the labor market, profit, not part of the labor market, interest. So the most appropriate there is wages, because we know wages, the labor market is characterized by the workers. So workers are paid wages. So at 8 there, the most appropriate becomes B. So we can indicate B as our most appropriate there. Then we go to the next one. We are now on 1.1.9. Right, 1.1.9 reads a condition where market forces do not allocate resources efficiently. So let's look at A. A is market power. Market power is the ability of a firm to determine the prices in the markets. The ability to influence the price level in the market or setting its own price is the market power. Then market price, we know that is the price of a certain product or commodity at a point in time is the market price. Then you go to market equilibrium, is the price level that is determined by the price mechanism, that is the forces and demand and supply. When we have the intersection of the demand curve and the supply curve, we have the equilibrium price being determined, and that's where we've got market equilibrium. So then market failure now is the most appropriate there. That's a condition where market forces do not allocate resources efficiently. So whenever we do not have the price mechanism taking its course, that's when we are going to notice market failure. So the most appropriate there is market failure, which is D. So we are going to indicate D as the most appropriate. Then I'll go to the last one in terms of the multiple choice part. It's saying the demand for capital is higher in countries with well-developed, and A is saying economy, primary sector, technology, public sector. So you'd see that the most appropriate that we have there is economy. And the question is saying the demand for capital is higher in countries with a well-developed. So you'd see that capital is mainly demanded in countries that we have that have a secondary sector, that where we have manufacturing of products. That's where capital is mostly demanded, not the primary sector. Then we have got the technology and public sector, not more appropriate than economy. So we have a well-developed economy determines the demand for capital. So A becomes the most appropriate that we have there. Then we now move on to the next question. Let's try to see what we have next there. Right, if you move on to the next part, is 1.2 is saying complete the following sentence by writing only the missing word or words next to the question number. That is 1.2, 1.2.1 to 1.2.5 in the answer book. Then the first part is saying continuous price increase is known as, we know that when level price is increasing in the economy, we call it inflation. And the opposite is true. When prices are going down, we've got a decrease in the level of prices in the economy, we call it deflation. So here, continuous price increase is known as inflation. So inflation here is the most appropriate, is the term that defines that explanation. Then we go to the next one, 1.2.2, saying when a mining house rents the rights to mine for gold, the payment it has to make is called. We know that whenever there's an issue of the use of rights to do something, there's an issue of royalties. So obviously, the appropriate answer there is mining royalties. Mining royalties. Then 1.2.3 saying supply of land is, we know supply of land, we know what we mean by supply. What can be offered in terms of a product on the market is what we call supply. So when we are talking about supply of land, we know that land cannot change. The land that we have cannot be increased or cannot be decreased to a certain extent. So basically what we are saying is the supply of land can always be fixed. So fixed is the most appropriate that we have there. We have fixed, and then we have got 1.2.4 is saying even if a command delivers no output, it must bear. We know that it must bear dash costs, and we know that the different types of costs that we have, we've got variable costs, we've got fixed costs. So on variable, we are saying the level of production determines the level of cost. If we are producing more, you incur more costs. Those are variable costs. If our production decreases, the level of variable costs will also decrease. So basically, we are saying there's a positive relationship between those two variables, that is output and the level of cost. But if we also have fixed costs do not vary with the level of output. Whether you produce no output, zero output, you will incur the same amount of costs. Even if you produce 1 million outputs, you are going to incur again the same level of cost. And you know the examples of fixed costs, we've got rent also is an example of fixed cost that you're always going to pay rent whether you produce or not. So that becomes a fixed cost. So now with the responses, with the question here, it must bear fixed costs. So fixed cost here becomes the response that we have here in terms of even if a company delivers no output, then it must bear fixed costs. Then we go to the next one. The inverse relationship between product price and quantity demanded is known as the law of demand. This is demand, right? The law of demand entails that if price increases, quantity demanded is going to be reduced. So basically, we have two variables that we have price, and then we have quantity demanded. So there's an inverse relationship. Inverse means there's a negative. If the one moves in a certain direction, the other will be moving in the opposite direction. Like in this case, if you have got price increasing, you're going to notice that quantity demanded will decrease, in the sense that if price increases, the goods become more expensive. So lesser people will have the ability to buy those goods. So we are going to see the quantity demanded going down. So we have a negative relationship that is going to be there between those two variables. Then that is what we have on 1.2. Then we move on to 1.3. Right. If you look at 1.3, saying choose the correct term from those in brackets, right? Only the answer next to question number 1.3.1 to 1.3.5 in the answer book. Right. The first part is saying signs that studies the relationship between ends and scarce means is what? Right. We've got macroeconomics and economics. And we know that macroeconomics becomes a component of economics, because economics is two branches. It has got microeconomics and macroeconomics. And then macroeconomics is the study of factors that affect the whole economy. You take, for example, we've got inflation, unemployment, they're affecting the whole economy. They fall under macroeconomics. Then microeconomics, it's the study of factors that are affecting individual firms and individual, be it industries. For example, if you look at the demand of a certain firm or company, we are looking from a smaller point of view, a smaller scale point of view. So it becomes microeconomics. So and then if you look at economics now, economics becomes broad. So economics on its own is defined by this explanation that it is the science that studies the relationship between ends and scarce means. So that in that 1.3.1, we are going to indicate economics as the most appropriate there. So you've got economics there. Then we go to 1.3.2, goods used to supply similar needs are dash goods right? We've got an option that we are going to make there in terms of substitute goods and complementary goods. And we know that substitutes are goods that can be used in place of another good, or they are used for the same function. And then complementary, they are goods that can be used together, but they won't be acting the same role. So if you look at here, the explanation is saying goods used to supply similar needs. So you do see that substitute becomes the most appropriate. So you have got substitutes there. Then we go to the next one, is saying the satisfaction that one gets from consuming a product is called what? We know that satisfaction that we gain from consuming a product is called utility. So utility becomes the most appropriate, but we have got also utils there. Utils becomes now a unity of measuring utility. A unity of measuring utility. You take, for example, we've got mass can be measured in kilograms. So kilograms becomes a unit of mass. That's the same that we are having there. We are having utility, and then utils becomes a unit that is used to measure utility. So that's what we have there. Let's go to the next one. The next one is saying labor time is mainly determined by the dash of the work day and the productive lifespan of the workers. We have got length and mass. That one is very clear. It means labor time is mainly determined by the length of the work day and the productive lifespan of the workers. Mass cannot be appropriate according to the construction of that sentence. So we have got length there. And then the last one on that one is monopoly can be dash or artificial. Monopoly can be dash or artificial. We know you can have artificial monopoly, and also you've got natural monopoly. So natural monopoly is the most appropriate there. Right. So we go on to look at what we have. See, we have something there. Can go to the next. Right. We have now 1.4. Right. If you look at 1.4, at the beginning of that question, is saying choose a description from column B that matches the term in column A. Right. Only the letter A to F next to the question number. That is 1.4.1 up to 1.4.5 in the answer book. Right. If you look at the first part, is saying capitalism, and we are looking for an explanation that relates to capitalism. I think the easiest way of answering this type of question, you go to column B, and then you start with A. You read A, quantity change, and you match it with the term that we have in column A. That becomes easier. So if you look at A saying quantity change, and we go down to look at what really matches quantity change. So first we have got capitalism. Capitalism, when we have got individuals that are controlling decisions in the economy, which is not appropriate for quantity change. Elastic demand, we know elastic demand is the responsiveness of demand to certain variables, change in certain variables. For example, we have got cross elasticity of demand, so we've got income elasticity of demand, price elasticity of demand. So in the case of price elasticity of demand, we are saying price, in price changes, to what extent is it stretching demand or changing demand in terms of the proportions. So if you go to savings, you look again there, we go to savings, you would see that savings is not appropriate there. So elastic, but when you look at elastic demand, you see that quantity change matches quantity change matches elastic demand, because on the quantity change, on elastic demand, we are saying is the quantity of change of the proportionate change of demand that has been caused by a certain variable. So here 4.2, here we have got A, that is matching that explanation A. And then we have if we go to B now, B is saying factors of production are owned and controlled by individual people and businesses. And the issue of private ownership we were saying is described by capitalism. So we are going to have B here on the first part. Then you go to objective of any profit-oriented firm. A profit-oriented firm is mainly concerned about making profit. So profit maximization becomes one of the major goals or objectives of a profit-oriented firm. So you've got profit maximization. So 1.4.4, we have C. Then we have got unspent part of income. And we know that income on its own, income, either we consume income or we save. Income on its own is equal to savings plus consumption. So the Y is representing income, the S is representing savings, the C is going to consumption. So that is what we have in terms of this formula. And we'd see that unspent part of income is the one that we did spend here. The one that we spent is the one that we consumed. So the one that we saved is the one that we didn't consume, we saved it. So savings becomes the most appropriate, which is D here. Then we go to periods of year. Period of year. Let's try to see if the explanation is extending downwards. So on periods of year, you would see that the most appropriate there is long run, because long run explains a period of a year. For those periods, we can have a short run and the long run. So the short run there, the short run and the long run are the periods that we have, and this one E is the most appropriate for 1.4.5. So if you go there, let's try to see there if we have got any response that we have there beneath that. Right. If you look here, other period of year, we also have period is long enough to change all production factors. So this one becomes more appropriate than the E that we have there. Of course, a long run becomes a period, but then F is saying period is long enough to change all production factors. We know that in the long run, that's when we have all factors of production being variable. Long run represents all factors of production being variable. So long run, we have all factors being variable. So this is explained here by period is long enough to change all. So the element of changing is the one that is being variable. Then another period is the short run. In the short run, we have got at least one factor being at least one factor being variable. So that's what we have. So F becomes the most appropriate for 1.4.5. So we have got F here. Right. So that marks the end of this question, question 1 in June 2023. So keep in touch for more questions as we prepare for exams. Those who haven't subscribed, please subscribe for more videos to come. With that, I'm out.